Usually, when we talk about the whole artificial intelligence boom, there is this, pervasive expectation of just total immediate disruption.
Oh, absolutely. The magic wand narrative.
Right, exactly. We are sold this idea of a magic wand. You take a deeply flawed, maybe legacy business process, you sprinkle some generative AI over it, and bam.
All your problems are solved.
Yeah, the old way of doing things instantly vaporizes, and suddenly you have this flawless, self-aware supercomputer running your entire back office.
It is the dominant narrative in the market right now, for sure. Just complete autonomy overnight.
Which is what everyone wants, right?
Well, honestly, it is an incredibly comforting thought. We really want to believe that technology can simply, abstract away all the messy, difficult human parts of enterprise work.
And do it without us having to put in the hard integration hours.
Exactly. But that is just a theoretical white paper.
Yeah, because then you step out of that theoretical space and into the actual messy real-world landscape of a Fortune 500 company.
A completely different beast.
It really is. You are suddenly dealing with heavily regulated industries, strict corporate compliance mandates, decades-old legacy systems that are holding mission-critical data.
Not to mention the actual human workforce dynamics involved.
Right. And when you drop a probabilistic, highly creative artificial intelligence into that kind of rigid environment, that magic wand suddenly looks a lot more like, an uncontrolled liability.
Yeah, a major compliance risk.
Exactly. We are looking at a technological landscape that is highly fragile.
It is a massive corporate tightrope walk. Because the reality of implementing enterprise AI is not about letting some brilliant but unpredictable artificial brain just run wild through your accounting department.
That would be a disaster.
Total disaster. It is fundamentally about control, governance, and verifiable outcomes.
Which brings us perfectly to today's topic. So welcome everyone to the special Talk Tickers edition of our Deep Dive.
Glad to be here.
For those of you managing your own portfolios out there, we know your time is super valuable. So our mission today is entirely data forward.
Just the numbers.
Just the numbers and focused on actionable analysis. We are taking a really close magnifying glass to UiPath's Q1 2027 earnings call.
Ticker symbol, PATH.
Yeah.
P-A-T-H.
That's right, $PATH. We're cutting through all the usual corporate speak to answer one fundamental question for you today. Is this stock a buy, a hold, or a fold?
And the narrative we are tracking with UiPath today, it's honestly one of the most interesting in the enterprise software sector right now.
Oh, for sure.
Because we were looking at a legacy automation company, a company that basically made its name building very strict rule-following robotic process automation.
Right, RPA bots.
Exactly, RPA. And we are watching them try to navigate the wild west of the generative AI boom.
Which is not an easy pivot.
Not at all. But based on the raw data from this quarter, they are managing this transition with a strategy that, honestly, many Wall Street analysts completely underestimated.
Well, we promised a data-forward approach, so let's jump straight into the top and bottom lines. Let's see exactly how UiPath performed against expectations.
Let's do it.
So we are looking at their first quarter of fiscal 2027. Q1 revenue hit $418 million.
Which represents a 17% year-over-year growth rate.
Right, 17%. And then their annual recurring revenue, their ARR, that reached $1.901 billion.
So an 11% increase year-over-year on the ARR.
Yeah.
Those top-line metrics indicate a very steady business, especially given the variable macroeconomic environment we are still operating in.
Yeah, IT budgets have been under a microscope.
Heavily scrutinized over the past several quarters. But, the top-line growth is not actually the real headline here.
No, it is absolutely not. The massive milestone, and this is what the retail investor really needs to zero in on, is that UiPath achieved GAAP profitability for the first time in the company's entire history.
A huge deal.
Massive. They reported $28 million in GAAP operating income.
And alongside that, their non-GAAP operating margin expanded to 22%.
Right. And furthermore, their balance sheet is just pristine right now. They are sitting on $1.4 billion in cash and cash equivalents.
With zero debt.
Zero debt. Okay, let's unpack this for a second. Because hitting GAAP profitability, it's kind of like a startup finally moving out of its parents' basement and paying its own rent, right?
That is a perfect analogy. Actually, it's critical to pause on the significance of that GAAP profitability milestone.
Why is it such a big deal for them specifically?
Well, in the enterprise software space, achieving genuine GAAP profitability has basically become the ultimate litmus test for the durability of a business model right now.
Because the free money era is over.
Exactly. We spent the last decade in a zero interest rate environment, and software companies were rewarded purely for top-line revenue growth, completely regardless of the underlying cash burn.
Right. It was all about user acquisition at any cost.
Yeah, you had companies reporting massive non-GAAP profits, which, if you look closely, essentially meant they were profitable, only if you ignored the hundreds of millions of dollars they were printing in stock-based compensation to pay their engineers.
Which is essentially financial sleight of hand.
Precisely. It was a metric practically designed to obscure the true hard cost of operating the business. But GAAP profitability, that is uncompromising.
You can't fake GAAP.
No, you can't. Achieving $28 million in operating income under GAAP means UiPath absorbed all of those real-world costs, including, by the way, the $53 million in stock-based compensation they issued this quarter.
Wow, so they absorbed that and still came out ahead.
Yes, they still generated undeniable bottom-line value. They are now a fully self-sustaining entity generating real cash flow.
So I am looking at that $1.4 billion catch pile with zero debt. And in an environment where the cost of capital is still relatively high, that is an enormous strategic weapon.
Oh, a massive advantage.
But I have to push back on the growth narrative here just a bit.
Sure, let's hear it.
As a retail investor actively monitoring the AI sector, my feed is totally dominated by companies posting 50%, 80%, sometimes triple-digit revenue growth.
Yeah, the AI boom numbers.
Right. The hardware layer, companies like NVIDIA, have just completely warped our expectations of what AI growth should look like. So I have to ask the hard question.
Go for it.
Is a 17% revenue growth rate really enough to excite the market? I mean, can you truly call yourself an AI powerhouse when your ARR is only growing at 11%?
That is exactly the core debate surrounding this stock right now. It's a very fair question.
Because 17% feels kind of slow.
If you only look at that 17% top-line growth in total isolation, yes. You could easily dismiss UiPath as just a mature, slow-moving software vendor.
Right.
However, comparing an application layer software company to the foundational hardware layer like NVIDIA is basically a category error.
How so?
Well, NVIDIA is selling the picks and shovels for the gold rush, right?
Yeah.
Every single company has to buy the hardware first just to train their models.
Right. You need the chips before you can build the software.
Exactly. So the application layer, which is where UiPath sits, it always lags the hardware cycle. Enterprises have to actually figure out how to integrate those models into their daily workflows before the software vendors see that massive revenue spike.
Oh, I see. So the argument here is that the real revenue acceleration for the application layer is still on the horizon.
Yes, but even more importantly, you really have to look at the composition of that 17% growth. This is the story behind the numbers.
Okay, let's dig into that.
The growth they are experiencing right now isn't just a slow, steady churn of their legacy RPA tools. It is being driven directly by their AI strategy, actually paying off in real-world enterprise deployments.
And the earnings call actually provided some incredibly specific data points on that front.
Yeah, they really brought the receipts.
They did. Management noted that 16 of their top 20 deals this quarter included AI components.
16 out of 20.
Yeah, that is an 80% attach rate on their largest, most complex contracts.
Which is huge.
But the metric that really demands attention, I think, is the expansion multiplier. Management explicitly stated that expansion deals that included AI were 6 times larger than the expansion deals that did not include AI.
6 times. That 6x multiplier completely changes the unit economics of their business.
That's massive.
It proves that their AI capabilities are not just defensive features. You know, they aren't just slapping AI on and giving it away for free to prevent customers from churning to some flashy new competitor.
Right. It's not a gimmick.
No, it is a massive monetization lever. When an enterprise customer decides to trust UiPath's AI orchestration, the scope of the deployment expands exponentially.
Because they can do so much more with it.
Exactly. They move from automating, say, a single department's workflow to integrating AI across the entire global operation.
They highlighted a really specific real-world example to back this up, involving one of the world's largest consumer electronics companies.
Oh, right, the coding agents.
Yes. This enterprise utilized UiPath's new coding agents. These are basically AI agents designed to actively assist developers in writing automation code.
And the ROI on this was crazy.
Unbelievable. By deploying these agents, the customer took a project build that historically required 4 weeks of intensive development time, and they compressed it down to just 3 hours.
4 weeks to 3 hours.
Yeah. Going from 4 weeks to 3 hours, that is the exact kind of hard return on investment that CFOs will instantly sign off on, even in a tight macro environment.
What's fascinating here is there was actually another example cited on the call with a major chip manufacturer, right? They reduced a 2-month project build down to just a few days.
It's just incredible efficiency.
It is. But to truly understand why UiPath is winning these massive contracts and driving that 6x expansion multiplier, we have to kind of examine management's fundamental philosophy on artificial intelligence.
Because it's quite different from the rest of the market.
It really is. They are taking a starkly different approach compared to all the pure play generative AI startups out there.
Right. CDO Daniel Dines went super deep into this architecture during the Q&A segment of the call.
He had to, because he was directly addressing the biggest existential fear the market has regarding UiPath right now.
The obsolescence fear.
Exactly. The bear thesis on this stock has always been that large language models will eventually become so incredibly capable that they will just completely replace the strict rule-based automation software that UiPath built its entire empire on.
Right. The market fears they'll just become irrelevant. The thinking is, if an AI agent can just look at an invoice and figure out how to process it on its own, why on earth do you need UiPath's complicated workflow software to tell it what to do step by step?
It's a very intuitive bear case.
And honestly, I am actually highly sympathetic to that bear thesis. Yeah, I look at the sheer pace of innovation with frontier models from, OpenAI or Anthropic. If they release a model next year where the hallucination rates drop to near zero and it can natively interface with enterprise APIs, doesn't UiPath's entire deterministic orchestration layer just become a completely redundant middleman?
I get why you'd think that. It is a valid concern on the surface, but it fundamentally misunderstands the real architecture of enterprise IT.
How so?
Dines countered this perfectly by explaining the irreconcilable difference between probabilistic systems and deterministic systems.
Okay, break that down for us.
So, generative AI models, no matter how incredibly advanced they get, are inherently probabilistic.
Meaning they deal in probabilities.
Right. They calculate the next most likely output based on massive data sets. They're incredibly creative. They can synthesize unstructured data brilliantly, but they are unpredictable by design.
They do not operate on fixed hard rules.
Exactly. They guess.
Highly educated guesses, to be fair, but still guesses.
Right. Now, I want you to overlay that probabilistic architecture onto a heavily regulated financial compliance process, or say a healthcare data privacy workflow, or even an international supply chain logistics protocol.
That sounds like a lawsuit waiting to happen.
It is. In these environments, you simply cannot tolerate a system that might occasionally decide to be, creative with a compliance report or a major invoice approval.
You definitely can't have an AI deciding that today the quarterly tax filing should have a 5% margin of creative variance.
Exactly. The IRS doesn't care how smart your AI is. Enterprise work at the Fortune 500 level requires deterministic automation.
Deterministic?
Yes. Deterministic means the system follows a strict, unyielding set of rules, step by step, identically, every single time. It is 100% reliable, and crucially, it is 100% auditable.
Right. Auditability is huge.
When the auditors come in, you have to be able to show them the exact logical path that led to a specific financial action. You cannot do that with a neural network's black box.
The AI guessed is not a valid defense.
No, it's not. If a deterministic bot encounters an edge case, it doesn't understand, it doesn't guess, it fails gracefully, it halts the process entirely, and it flags it as an exception for a human to review.
Which is exactly what management was emphasizing. They made a really definitive claim on the call that probabilistic AI cannot and will not replace deterministic automation in these heavily regulated environments.
Because it is neither economically feasible nor architecturally safe.
And that is their moat. They are not fighting the foundational models, they are wrapping them.
That is the perfect way to phrase it.
Think of traditional deterministic automation like a heavy freight train on tracks.
Right.
It is incredibly reliable, it carries a massive load safely across the country, but it absolutely cannot steer around an obstacle. It only goes exactly where the tracks have been explicitly laid.
Right.
Conversely, think of these new generative AI agents like a high-performance off-road vehicle. They're infinitely flexible, they can navigate complex, uncharted terrain, but if you aren't paying close attention, they might just drive you straight into a ravine.
Or off a cliff.
Exactly. So What UiPath is selling is essentially the heavily fortified guardrails and the GPS coordination system that safely manages both of those vehicles. They are taking the unpredictable, probabilistic AI and encasing it in a strict deterministic shell.
That analogy perfectly illustrates their product strategy, which, by the way, they have formalized into a platform called Maestro.
Maestro?
Yeah, Maestro is a process orchestration layer. It acts as the actual central nervous system for the enterprise.
So it's not just the bots anymore.
No, it doesn't just manage the new AI agents. It coordinates human workers, decades-old legacy mainframe systems, deterministic RPA bots, and probabilistic AI models all into a single governed, auditable workflow.
And they provided a super compelling example of this orchestration in action with a Fortune Global 500 electronics manufacturer.
The one that ripped out a competitor.
Yes. This company actually ripped out a competing software platform and displaced them with UiPath. And the specific reason given was that UiPath was the only platform capable of taking them from simple, isolated task automations all the way up to orchestrating complex, enterprise-wide business processes globally.
They are using Maestro to coordinate every single layer of their digital workforce.
But this does introduce a massive technical challenge, which I think we need to analyze fairly.
Absolutely.
When you are using AI to generate code incredibly fast, like that example of shrinking 4 weeks of development into 3 hours, you are suddenly deploying a massive volume of new automations into the enterprise environment.
A huge volume.
And historically, the fragility of automations has been the biggest bottleneck for this entire industry.
Right, because enterprise software is constantly changing.
Exactly. You build an automation to pull data from, say, a Salesforce portal, and then Salesforce updates their user interface. They move a button 3 pixels to the left, and your entire automated workflow just crashes.
It breaks the bot.
Right. So how do you manage the maintenance burden when AI is helping you build thousands of new automations?
This is where the technical mechanisms they introduced become fascinating, because they clearly saw this problem coming.
They did.
They announced a massive focus on their test cloud and what they are calling healing agents.
Healing agents.
Yeah. They recognize that more software simply means a larger surface area for things to break. So they have introduced specific AI agents whose entire existence is dedicated to sitting in the background and monitoring the health of the deterministic automations.
Okay, let's break down how a healing agent actually operates in a live environment, because this addresses the whole Band-Aid criticism people have.
Right. It doesn't just arbitrarily push new code to production when something breaks.
No, it's smarter than that.
When a process fails during runtime, say like your example, a web portal updates and the automation suddenly can't find the login field, the healing agent immediately identifies the failure point.
It sees the error.
It then actively evaluates the new user interface, determines the necessary fix, and tests that fix in a parallel sandboxed execution state.
So it tests it safely first.
Exactly. It essentially simulates the repair to ensure it works without breaking any downstream dependencies.
And crucially, it doesn't just deploy that fix blindly into the wild. If the fix is minor and within its pre-approved governance parameters, it can repair the execution on the fly so the business process continues totally uninterrupted.
Which is amazing.
But for more complex failures, it gathers all the diagnostic context, actually writes the proposed code fix, and routes it to a human developer for a simple one-click approval.
They are effectively embedding a digital IT support team directly into the platform infrastructure.
The value proposition there is just enormous. It shifts the entire cost structure of maintaining an automated enterprise.
Because you are no longer spending highly paid engineering hours doing routine maintenance on broken scripts.
Right. You are letting the AI maintain the deterministic machinery, which frees your human capital to focus on actual strategic deployment.
It's a huge shift.
Now, this technical architecture, the Maestro orchestration, the deterministic wrappers, the healing agents, it proves the technology is viable today. But to make a real determination for the retail investor listening, we have to pivot to the financial implications.
Right, the bottom line.
If the technology is actively driving those 6x larger deal sizes, what is management signaling about the future? We need to see if the forward guidance aligns with this technological optimism.
Yeah, we have to look very closely at how management is projecting their financial trajectory here.
So what are they saying?
Looking at the full fiscal year 2027, management actually raised their guidance.
Okay.
They are projecting full year revenue to land somewhere between $1.76 billion and $1.781 billion.
Wow.
Furthermore, they projected non-GAAP operating income to hit approximately $430 million, with non-GAAP adjusted free cash flow of $425 million.
So those margins demonstrate significant operating leverage.
Massive leverage.
As revenue scales up, a massive portion of those incremental dollars are flowing straight to the bottom line.
Exactly. But the metric that really requires deeper analysis here is their net dollar retention, or NDR.
Right, NDR is huge in SaaS.
They reported that NDR is stabilizing at 109% or 108% if you strip out the fluctuations from foreign exchange rates.
Okay, an NDR of 109% indicates that existing customers are indeed expanding their spend, which validates the whole land and expand software model.
Yes.
However, we have to contextualize this. During the absolute peak of the software as a service boom, best-in-class companies were routinely posting NDRs of 120% to 130%.
Oh, easily.
Exactly. So a 109% NDR is healthy, sure, but it's not the hyper-growth metric it used to be. Is 109% the new ceiling for UiPath in this current macroeconomic climate?
Well, it might be the stabilization point, but you really have to dissect the underlying customer behavior to understand the actual quality of that 109%.
What do you mean?
If you look at who is actually expanding their spend, you see a very deliberate strategic shift in UiPath's go-to-market motion.
Okay.
The cohort of customers generating over $1 million in annual recurring revenue grew by 18% year over year.
18%.
They now have 374 distinct customers, paying them over $1 million every single year.
That's incredible.
Additionally, the cohort paying over $100,000 grew by 11%.
So the enterprise segment is clearly expanding rapidly.
Very rapidly.
But we do have to address the attrition at the bottom of the funnel.
Yes, the churn.
Right. CFO Ashim Gupta explicitly noted on the call that they are experiencing customer attrition. He specified that this churn continues to be heavily concentrated among their quote-unquote smallest customers. He also mentioned that personal productivity and simple, isolated task-based automation now represent a very small part of their overall portfolio.
This is a critical strategic pivot for them.
You see, it feels like a high-wire act to me. Historically, in the software industry, the long tail of small and medium-sized businesses is your top of funnel.
Usually, yes.
You acquire them cheaply, and as they grow, they spend more. So is bleeding out these small customers a major red flag for the long-term health of the business? Is it a mistake to abandon the lower end of the market?
In a different software category, maybe it would be a red flag. But in the enterprise orchestration market, shedding the low end is definitively the smarter play.
You think so?
Absolutely. Think about what UiPath is actually building right now. A central nervous system that coordinates legacy mainframes, modern cloud applications, customized deterministic bots, and frontier AI models.
Right.
That is not a product suite designed for a 5-person accounting firm trying to automate some data entry on a basic Excel spreadsheet.
Yeah, the implementation alone would probably bankrupt a small business.
Exactly. Servicing thousands of tiny clients with simplistic use cases is a massive drain on support resources, and it drastically drags down your gross margins.
That makes sense.
By allowing the low-end, low-margin users to just churn out naturally and aggressively focusing their sales and engineering teams on the complex Fortune 500 enterprise space, they're securing significantly stickier revenue.
And the data actually supports that conclusion. Their gross retention rate, which measures how many customers stay with them regardless of any expansion, remains at a best-in-class 97%.
97% is basically zero churn at the top.
Yeah. The massive global players, once they integrate UiPath, simply do not leave.
They cannot leave. The switching costs are astronomically high.
One of the examples on the call highlighted a major global telecommunications company that currently has nearly 2,000 distinct processes automated through UiPath. 2,000. That deployment is saving them over $30 million annually in operational costs. And they are currently building a pipeline of 200 additional deterministic automations alongside 20 new AI agent use cases.
Wow.
When you have 2,000 core business processes entirely reliant on a single orchestration layer, you do not just cancel your subscription to save a few bucks.
No, you definitely don't.
It would be the corporate equivalent of a human deciding to surgically remove their own central nervous system.
Exactly. The lock-in effect at the enterprise level is profound, and management clearly understands the inherent value of this sticky, high-margin revenue.
Which brings us to the capital allocation.
Yes. The ultimate proof of their confidence in the strategic pivot brings us to the most aggressive financial maneuver detailed in the earnings report: their capital allocation strategy regarding stock buybacks.
This is a massive component of the story. They did not just achieve GAAP profitability and hoard the cash on their balance sheet.
No, they went shopping.
During the first quarter, UiPath repurchased 20 million shares of their own stock at an average price of $11.47.
20 million shares.
And following that, since April 30th, operating under a pre-established trading plan, they bought back an additional 2 million shares at an average price of $9.63.
They have removed tens of millions of shares from the open market.
We need to analyze the implications of a buyback at this specific scale and price point.
We do. A software company achieving first-time GAAP profitability, sitting on $1.4 billion in cash, and choosing to aggressively repurchase over 22 million of its own shares at the $10 to $11 level. Well, that sends an undeniable signal to Wall Street.
So what does this all mean? I mean, I have to ask about the opportunity cost here.
Okay.
They have $1.4 billion in cash. We are in the middle of the biggest AI gold rush in history. Why are they utilizing their capital to buy back their own stock instead of aggressively acquiring the next hot AI agent startup? Wouldn't M&A be a better use of funds to secure their technological moat?
That is the exact debate happening in boardrooms across the tech sector right now. That's a great point.
Right.
But the decision to execute a buyback rather than pursue aggressive M&A indicates two things.
What's the first?
First, AI valuations in the private market are currently absurdly inflated. Buying an unproven AI startup right now requires paying a massive, massive premium.
Yeah, the multiples are crazy.
Second, and more importantly, it signals that the executive team and the board of directors firmly believe the public market is fundamentally mispricing their own stock.
So they believe their own equity is undervalued.
Exactly. From a pure capital allocation perspective, stock buybacks serve a mechanical purpose, right? They reduce the total number of shares outstanding, which artificially boosts the earnings per share, or EPS.
Making the stock mathematically more attractive to institutional investors.
Right. But the psychological signal is even stronger. They are stating that investing in their own business at $10 a share is the absolute highest return investment they can make with their cash, even while acknowledging the variable macroeconomic environment.
It is the ultimate display of insider confidence. They are betting heavily on their own transition strategy.
They really are.
Which brings us perfectly to the final phase of our deep dive today, the bottom line.
Let's wrap it up.
We have looked at the historical financial data. We have dissected the technical mechanisms behind the story, understanding the absolute necessity of putting a deterministic wrapper around unpredictable AI models.
Essential for the enterprise.
We have reviewed the forward-looking guidance, the deliberate shift toward enterprise clients, and the massive share repurchases. It is time to pull all of these threads together into a clear, actionable verdict for you, the retail investor listening right now.
Based on the totality of the data provided in the Q1 2027 call, our analysis requires us to take a definitive stance on the stock's trajectory.
And the official talk ticker stance for this deep dive is bullish. We are looking at a fundamentally bullish signal on ticker symbol PATH.
For the listener who is currently holding shares or considering establishing a position in PATH, this earnings call serves as a crucial point of divergence.
How so?
It fundamentally separates UiPath from the vast sea of pure AI hype stocks.
Oh, definitely.
A hype stock is selling a theoretical vision of the future while actively burning through cash to figure out their product market fit. UiPath is operating a functional, profitable reality today.
Right. They have a massive $1.4 billion cash cushion. They carry zero debt. They are generating GAAP-verified bottom-line cash profits.
Real cash.
Real cash. And they're utilizing that cash to actively buy back shares at what their board perceives to be a steep discount.
Furthermore, they are mathematically proving that their AI integration strategy is actually working. They aren't just issuing press releases about AI, they are actively driving revenue with it, increasing their expansion deal sizes by a factor of 6.
That 6x multiplier is huge.
It is. They are successfully monetizing artificial intelligence by solving the exact problem that is preventing widespread enterprise adoption: the demand for trust, governance, and deterministic reliability.
If you synthesize the broader strategic arc we have covered today, you can really see that UiPath is successfully crossing a massive technological chasm.
A very difficult chasm.
They are transitioning from being viewed merely as a legacy RPA vendor, a market that, let's be honest, many feared would be rendered entirely obsolete by large language models, to establishing themselves as the indispensable process orchestration layer for the AI era.
They're becoming the vital infrastructure that actually makes AI safe and effective for corporate use.
It is a highly compelling case for the durable value of their platform. They are embedding themselves so deeply into the operational fabric of the Fortune 500 that dislodging them becomes nearly impossible.
Extremely sticky.
So, just to give you a quick, snappy recap of exactly why UiPath earned a bullish rating on today's breakdown.
Let's hear it.
They achieved GAAP profitability for the first time ever. They maintain a pristine balance sheet with zero debt. They are seeing 6x larger deal sizes driven directly by AI expansion, and management demonstrated massive insider confidence by repurchasing 22 million shares.
The numbers are clean, the strategy is coherent, and the narrative is actually materializing in the real world.
It paints a very clear picture of a company that understands exactly what their enterprise customers require in this highly transitional period.
It does.
Which leaves us with a final, provocative thought for you to ponder long after this deep dive ends.
Something to mull over.
We all acknowledge that the frontier AI models, the massive probabilistic brains currently being built by OpenAI, Anthropic, Google, and others, are eventually going to become cheap, highly commoditized utilities.
Just like cloud computing storage or access to electricity.
Exactly. So as those brilliant artificial brains become universally accessible and cheap, the true long-term trillion-dollar value in the technology sector actually belong to the companies manufacturing the brains.
That's the million-dollar question. Or trillion-dollar, I should say.
Or will the ultimate economic value accrue to the orchestrators like UiPath? The deterministic machinery, the steering wheels, the brakes, and the guardrails that actually force those unpredictable brains to perform reliable, safe, and auditable work in the real world.
It really is the classic gold rush paradigm.
Yeah.
Do you invest your capital in the thousands of prospectors hoping to strike a vein of gold? Or do you invest in a single company selling the picks, the shovels, the heavy machinery, and the maps required to extract it safely?
Exactly. You don't just throw a massive, powerful engine in the passenger seat and hope the car figures out how to drive itself to the destination.
No, you definitely don't.
You need the infrastructure to connect the power of the engine to the wheels. And based on this quarter's data, UiPath is building the best digital steering column on the market.
Well said.
Thank you for joining us on this high-impact Talk Tickers deep dive. Keep exploring the numbers, and we'll see you next time.